right, so with that being said, we are ready to begin discussing leases. Let's see if I can make this big. Now, there are quite a few slides in this slide deck. We're not going to cover all of them. The appendix includes information that is beyond the scope of what we need to discuss. We are really going to look at the broad category of capital leases, and we'll look a little bit at operating leases. With the capital leases, we can have a finance type lease or a sales type lease, depending on whether you are the lessor or the lessee. So we'll see the journal entries that are necessary for the lessor and lessee under those categories. And we'll also briefly take a look at the journal entries for the lessor or the lessee for operating leases. To cap it all off, we'll look at presentation and disclosure as well. All right, so sometimes companies want to purchase big ticket items, or even individuals want to purchase big ticket items, and they may not be able to obtain financing for it at higher interest rates. So sometimes companies will opt to lease things like cars, copiers, computers, airplanes, all of those different items. Sometimes companies decide to lease or enter into leasing arrangements because there are tax benefits for the lessor. For the lessee, it provides them with flexibility so they can switch out. They don't have to worry about products going obsolete as much. So the leasing environment certainly offers a bunch of different opportunities for companies, and the majority of companies will use leasing arrangements. Even at Goldie, the copiers that we have are leased. I'm not sure if the computers are leased, but the copiers are leased. That way, if they break down, we don't have to worry about fixing them. The company that we are in the leasing arrangement with, they'll come in and fix them. When the copiers get old, they'll come in and give us new copiers. The interesting thing about leases is that several years ago, leases could be structured so that you could avoid showing debt on your balance sheet. So because of that, GAAP or FASB got together and decided that GAAP needs to be changed. And now if we're looking at an operating lease or a capital lease, you still have to show the debt connected to it. So in the past, companies were trying to structure things to make themselves look good, and it wasn't completely clear to the users of the financial statements that, hey, there's this additional liability that's out here, or hey, there's the right to use this particular asset. So in some cases, the lessee would show an asset on their balance sheet, and the lessor wouldn't show, or would show the same asset on the balance sheet just based on how things were structured. It was really weird. And with the lessee, they show the asset but not the debt. And then you have the lessor showing that same asset on the balance sheet. So it's completely confusing. And now it's a whole lot more clear for the users of the financial statements, because it's not necessarily about the asset itself from the lessee standpoint. It's about the right to use that asset. For the lessee also has to show that lease liability on their balance sheet. So things have certainly been changed to make life easier for the users of the financial statements. Back in, I think, 2022, 2023, probably 2022 was when it was required that companies made the final changeover to the new lease standards. And companies and banks were flipping out because they were saying, oh, all of a sudden we had no debt on our balance sheet, and now we have to show all of this debt from these leases. How are our banks going to look at us? Are we now going to be in violation of loan covenants because now we have this new debt that we didn't have before? But we eased into it, and the fallout from it wasn't as bad as we all thought. I think that's just an accounting thing where we just panic when there's not necessarily a reason to panic. All right, so here are the advantages. I mentioned some of them already. We can obtain financing at a lower cost. It gives us that flexibility from the lessee standpoint. From the lessor standpoint, if we're dealing with big ticket items like John Deere equipment or construction vehicles, then we can stimulate sales if we have additional options outside of just purchasing, and then the customer has to go out and get a loan. If we offer a leasing arrangement, then we can generate more sales. Of course, I mentioned there are tax benefits. And then once the lessor is finished with the asset, if they're not using it for an incredibly long time, let's say they're using it only for a couple of years, the asset comes back to us with a high worth. We call that worth residual value. That's how much the asset is worth at the end of the leasing arrangement. So when we get an asset back with a high residual value, we can turn around and lease it to someone else, or we can sell it to someone else. So we get to continue making money off of that high residual asset, as long as the lessee doesn't destroy it during the time that they have it. All right, so how do we tell whether or not we're dealing with a capital or finance lease or an operating lease? So with a finance lease, again, that is the one where where the transaction is structured such that it looks like the lessee is borrowing the money. In essence, when we look at the details of the transaction, the lessee gets to use up the asset, in essence. When the transaction looks like that, we have to make sure we do the entries a certain way so that it is clear to the users of the financial statements that, hey, this is kind of like the lessee is borrowing money and paying for the use of this asset versus just a regular old lease agreement that ends after a couple of years. With an operating lease, let's say that you are renting an apartment. That's usually an operating lease, because with that apartment, once the lease is over, you don't get to keep the apartment. The rights to use that apartment will revert back to the lessor. In addition to that, you're only limited to your apartment or maybe the clubhouse. You don't get access to every single apartment in the apartment building. So you're only getting to use a tiny piece of that asset. And because of that, the way that is shown on the financial statements is a bit different from a financing type arrangement. So we have quite a few criteria that we have to go through to determine whether a lease is a finance lease or an operating lease. The interesting thing about these criteria, I think there are like 5 or 6 of them. All you have to do is meet one. As long as you meet one, then the lease needs to be classified as a finance lease. With an operating lease, it's very similar to dealing with rent expense and then crediting cash. That's what we used to do years ago. We would debit rent expense and credit cash if we were the lessee. If we were the lessor, we would debit cash and credit rent revenue on the flip side of that. So with the operating lease, I want you to think more, it's similar to more like a short-term type of arrangement, where a financing type lease, we're going to see an interest component. We're going to see some amortization and things of that nature. So one of the first tests that we have to meet is whether or not ownership is transferred to, or control is transferred to, the lessee. So if the lessee has total control of the asset as a result of the contract, then immediately it's a finance lease. Just like the example I gave you with leasing a car, you have control, you take ownership for that time. That is typically classified as a finance lease. But if you're renting an apartment, you don't get control of the entire apartment building. So that's more like an operating lease. In addition to taking ownership, the lessee will end up using up the asset, as I mentioned. So a large portion of the fair value is being paid for by the lessee. Or if the asset lasts for 4 years and the lease agreement is for 4 years, then as a lessee, I'm using up the asset for all of its useful life. So in that situation, that meets the criteria for a finance lease. So let's look at an example, because sometimes when I talk about this in theory, it doesn't make much sense. We're going to look at quite a few examples tonight. So we have this company and they lease one floor of an office building for 5 years. And at the end of the lease, the lessee leaves the floor. The lessor can then lease the floor to another tenant. Based on this information alone, can we determine whether this is a finance lease or an operating lease? With a finance lease, keep in mind, we're looking at one of those situations where ownership is transferred to the lessee. In this transaction, ownership is not transferred to the lessee. So this would be categorized as an operating lease. Let's keep going. All right. Oh my goodness, that is so small. And I have on these glasses, so I'm not going to be able to see it. And I'm on this laptop. All right, but it's okay because I know what the tests are anyway. Now, remember I said there are about 5 or 6 different tests. We've seen one of them. Here are the other 5. If you meet one of the criteria that's listed here, then the lease is classified as a finance lease. If you don't meet any of them, then it is an operating lease. So the first one is that transfer of ownership. We've already seen that one in that example. The next one is the purchase option. And not just a purchase option, is there a bargain purchase option where at the end of the life of the lease, we give the lessee a chance to purchase the asset for a cheaper price. Then there is the lease term test. I like to call this the 75% test. With the 75% test, is the lease term for longer than 75% of the asset's useful or economic life? So we'll compare the lease term to the economic life of the asset. We'll do a little division, a little calculation, and we'll determine that percentage. If it's greater than 75%, then we've met this test. It should be a finance type lease. Then there is the present value test. For the present value test, we're going to find the present value of the lease payments. And the lease payments include the monthly or annual payments that we'll make, and also any guaranteed residual value. And we'll talk about that more in a second. But as long as the lessee ends up paying 90% or more of the fair value of the asset, then it's a finance type lease. Again, we're trying to see whether or not the transaction is structured so that the lessee is really just borrowing the money from the seller or the lessor. And if it looks like the lessee is really just borrowing the money, they're getting all the use of the asset, they're paying for most of the asset, they get the ownership of the asset when everything is over. When all those elements are in place, then it's really a financing type of arrangement, not a rental type of arrangement. And then the last test is the alternative use test. If the lessor has no other use for the asset at the end of the lease term, then it meets the qualification of a finance type lease, because that means that the lessee has used the thing up. The lessor has nothing to do with it now. They're just going to throw it away. But if it's something like a car or something with a high residual value and the lessor can then turn around and lease it to someone else, then that test is not met. It could end up being an operating lease. All right, so now let's look at some examples of each one. We've already seen that first one with the transfer of ownership. We saw that example. Now let's look at the bargain purchase option test. And I always put that word bargain in there because a lot of lease arrangements will have the opportunity to purchase the asset at the end of the lease term. But it has to be a bargain, and it has to be likely that the lessee is going to take advantage of it. So let me give you an example. Let's say that I am renting a Tesla, which I would probably never rent a Tesla, but it's just for pretend. Let's say that I'm renting a Tesla and I make my monthly payments, and I don't know, my lease payments are $3,000 a month, and I'm only leasing it for a year. So I pay my $3,000 a month. That's a lot for a Tesla. Hold on. I'm tired, as you can tell. I'm paying my $1,000 a month for a Tesla, and I'm renting it for a year. And the whole thing probably cost me, I don't know, $90,000. Now, at the end of that 1 year period, after I make my $12,000 in payments, $1,000 a month, I am given the option to purchase the Tesla for $1. Now, do you think that I'm going to take advantage of that and purchase a Tesla? And you don't have to answer this rhetorical question. Absolutely. If it's the final price is 90,000 and I've only had to pay 12,000 and $1, yes, absolutely. I am going to take advantage of that bargain purchase option. Now, why do we care again? Because if there is a bargain purchase option, then this is essentially a financing arrangement. The company that entered into this agreement with me allowed me to use the asset for a year, and I paid for it for a year. And then at the end of the lease term, I give them my $1 and they give me the asset. So in essence, it's like I borrowed $12,000 to pay for it. All right, here's a better example. This company leases an Accord for $499 per month for 40 months, more realistic numbers, with an option to purchase the Accord for $1,000 at the end of that lease. So we're looking at not an extremely long time, and more than likely, the customer is going to take advantage of that option to purchase that Honda for $1,000. So the answer to this one is yes, which means you meet this qualification automatically. This is a finance lease. The interesting thing about all of these criteria is that as soon as you meet one, you don't have to go through all of the other tests to see if it's a finance lease. All you have to do is meet one. Now, because it's fun, I go through every single test. So when we look at examples, we'll look at every single test, but you only need one to meet the criteria for a finance lease. Now, let's look at the lease term test, or the 75% test. That's what I like to call it. Remember, with the lease term test, this is the one where we compare the life of the lease to the life of the asset. So we're going to take the lease term and divide it by the asset's economic life, because usually the economic life is longer than the lease term. If that percentage is 75% or more, then the lessee is essentially using the asset all up. They're getting all of the benefits of the economic life of the asset. So because of that, it is a finance lease. If there is a bargain purchase option, or a bargain renewal option, I should say, that can extend that lease period. So in the example we just saw with the Honda, instead of the option to purchase it at $1,000, maybe there is an option to continue leasing that particular item for $50 per month. I think they were paying $400 per month before. Now we bring it down to $50 per month. Well, more than likely, the customer is going to take advantage of that, and that extends the lease term. So if there is a bargain renewal option, we do need to consider that in the lease term. So again, let's see a better example. Now, let's assume that Home Depot leases computers for 2 years at a rental of $100 per month per computer. Home Depot can lease these computers for $10 per month per computer for another 2 years. So because of this bargain renewal option, the lease term is not 2 years, it's actually 4 years. So what we would do is take the economic life of these computers, and we would compare that to the lease term. So if the economic life was, say, 5 years, and the lease term is 4 years, we divide that, we take that 4/5, find that percentage, and then we know that that's greater than 75%, and it would qualify as a finance lease. Questions on the 75% test. All right, now let's look at the 90% test. With the 90% test, this is all about the fair value, the present value, excuse me, of the lease payments. So we did all of that work in intermediate one with the time value of money, and it comes back to haunt us again because now we have to find the present value of our lease payments. If the present value of our lease payments is 90% or more than the fair value of the asset, then we are essentially, as the lessee, paying for the entire thing. So because of that, this lease would be categorized as a finance lease. Lease payments include the rental amount, and again, that could be annual or monthly. Sometimes the rental amounts can be fixed payments, sometimes they can be variable payments. It also includes any guaranteed residual value. Now, with residual value, that is what the lessor expects to receive at the end of the life of the lease. In other words, if we're renting, I don't know, another car, and if the lessor puts in the contract that, oh, the asset should be worth $5,000 at the end of the lease term, that's their way of saying, hey, don't run my vehicle into the ground. And if you do, I may charge you for it. That $5,000 is the residual value. In some contracts, the residual value is guaranteed, and in others, it is unguaranteed. If it's unguaranteed, then the lessee, if when they turn that asset back over to the lessor, if they run the asset into the ground, the lessor gets nothing if that residual value is unguaranteed. But if it is guaranteed and the lessee runs the asset into the ground and it's not worth the amount that is specified in the contract, then the lessee has to pay money to replace that guaranteed residual value. Now, why do we care about this from the standpoint of the 90% test? Because the lessee may have to pay this amount back. So that should be included in the present value of all of my lease payments. So yes, it includes the rental payments, but it also includes the promised value that should be returned back to the lessee. And then there also may be payments that are required to purchase or terminate the asset at the end of the lease. But generally, we're looking at fixed payments and guaranteed residual values for the bulk of the examples that we'll see. Because these examples can get pretty crazy, and I want to make sure that you understand the nuts and bolts of this without throwing tons of details and way too much information. And speaking of way too much information, we're going to skip this problem because I don't need this problem. All right. When finding the present value of the lease payments, we need to use a certain rate. Usually we use the rate that is implicit in the contract. A lot of times this implicit rate is given to the lessee. Sometimes it is not. If it is not, then the lessee has to use their own incremental borrowing rate, which is essentially the rate that they pay interest on the loans that they have right now. Now, when you're given a problem, sometimes you'll be given the implicit rate. Sometimes you'll be told that the implicit rate is unknown. Sometimes you'll be given both of them. Which one are you supposed to use? Well, if you're given the implicit rate, always use the implicit rate. The only time you use the incremental borrowing rate is if the implicit rate is unknown. So Wiley Plus will throw you some problems and you'll be given both rates. You want to head towards that implicit rate, not the incremental borrowing rate. Now, we'll see a couple of examples where we'll have to calculate the present value of the lease payments to determine whether or not the 90% test is met. And then the last test is the alternative use test. If the lessor doesn't have any other use for this asset, that means they built it to specifications for the lessee, and the lessee has gotten all of the value out of that asset. So it's really a finance lease. If the lessor can use it for something else, then that criteria is not met. I need to go back. There we go. All right, let's take a look at this example. There are actually 3 different examples, tons of information, and we are going to go through each one of these companies to determine whether or not the criteria has been met using all of our different tests. So we have Morgan Bakeries involved in 3 different lease situations. Each lease is non-cancelable, and in no case does Morgan Bakeries receive title to the properties leased during or at the end of the lease term. Why in the world they tell me that? Well, they told me that to let me know that the first test, that transfer of ownership test, has not been met because the lessor keeps the title to the properties. Now, all leases start on January 1 with the first rental due at the beginning of the year. Oh, goodness, we're looking at rental payments happening at the beginning of the year. Why do we care? Well, when we find the present value of the lease payments, we have to remember to use the table for the present value of an annuity due because the payments are happening at the beginning of the period instead of the end. For each lease, assume that the lessors have an alternative use for the assets at the end of the lease unless ownership transfers to the lessee. Now, why do they give us that sentence? To tell us that the last test, that alternative use test, has not been met. So we have to focus on the bargain purchase option test, the 75% test, or the economic life test, and the 90% test, or that fair value of the lease payments test. Additional information shown in the table below, and FV is for fair value, RV is for residual value, and PV is for present value. So let's look at the first one. For Harmon Company, it's nice that they tell me the type of property that's being leased, but I don't really care. There's tons of information here. And rather than read all of the information, I'm going to go directly to my test. Go back. I'm going to go directly to my test. My first test is the economic life test. For the economic life test, I'm going to take the lease term. Notice the lease term is 20 years. And I'm going to divide it by the estimated economic life of 30 years. When I do this, I know I get 2/3 or 67%. The 67% is less than 75%. I did not meet the criteria. So as of right now, this is looking like an operating lease. I have to go to my next test. So for this first one, I did not meet the economic life test. Now, let's see if there is a bargain purchase option. So I'm looking, see my lease term, here we go. I have a purchase option of $35,000 at the end of 20 years. That's interesting. That's pretty high. I wonder what the fair value of this item is at the end of the lease term. Let's see. The residual value that is unguaranteed is $35,000. Well, wait a minute. If the lessor believes that the asset should be worth $35,000, and they offer me the option as the lessee to purchase this at the end of the life of the lease for $35,000, that's not a bargain. I'm paying exactly what it's worth. So even though there is a purchase option, there is not a bargain purchase option. So for this one, Got to be really careful. So that test is not met. It's not a bargain purchase option. All right, questions so far? Okay, we have one more test to do. And that last test is the 90% test, where we look at the fair value of the asset. Now, this asset is worth $75,000. And I'm going to take that. I have my calculator here. That's why I'm looking down. I'm going to take that 75,000. And I'm going to multiply it by 90%. And when I multiply it by 90%, I get 67,500. So it is my expectation that for that 67,500, that when I take the present value of all of my lease payments, that the number needs to be more than the 67,500. If the number is more, then that criteria is met, and this is a finance lease. If the number is less, then I don't meet the criteria. It's an operating lease. Now, I could do this the long way, or I could just look at the information that's on the screen here. When I find the present value of my lease payments here, I have my yearly rental of $6,000. So I would take that $6,000 and multiply it times the present value of an annuity due for 20 years using, let's see, the implicit rate is unknown. So I have to use the rate of 8%, the incremental borrowing rate. So when I multiply that by my factor, it's already been done for me. I get that 63 and some change, and I see that this test has not been met. So for this first leasing arrangement, this is an operating lease. It's not a finance lease. I didn't meet any of the criteria. All right, questions on that first one? Now, just one thing I want to highlight, because when we found the present value of the payments here, we only included the 6,000. I did not have to find the present value of the residual value. We only do that if the residual value is guaranteed. So you'll see when we get to the next one that when we find the present value of the payment, it's going to include the present value of an annuity due, as well as the present value of a single sum for the guaranteed residual value. Oh, dang it, keep moving forward. All right, so we'll do the middle one together, and then I'll let you do the last one, and you can tell me what type of lease the last one is. So let's do the middle one together. All right, so I'm going back through my test. I like to do the 75% test first. We also call that the economic life test. I take the lease term of 3 years and I divide it by the economic life. And look at that. It's 3/4, it's 75%. I'm done. I already know this is a finance lease. But because this is so fun, we have to go through all of the tests. You don't have to. You meet one criteria, you're done. But I like to go through all the tests just to make sure that you thoroughly understand. All right, the next one is the bargain purchase option test. And I see that for purchase option, there is not one. So there's no bargain purchase option. So that test is not met. Let's see. I see that there is a renewal option. 1 year at $1,500. There's no penalty for non-renewal, and it is a standard renewal clause. Ultimately, that could affect my present value, but it's fine. We've already met the economic life test. If anything, it makes me at 100% instead of 75%. Now, let's look at the 90% test. The fair value of this asset is $20,000. And if I take 90% of that, I need the present value of my lease payments to be greater than 18,000. So the 20%, excuse me, the 20,000 times the 90% gives me 18,000. Now, when I find the present value of my payments, I'm going to find the present value of an annuity due for the 5,000 and some change for, let's see, over the life of my lease. And where is my interest rate? The implicit rate is not known, but I know my incremental borrowing rate of 8%. So I use my incremental borrowing rate again. And I also find the present value of the guaranteed residual value. And those two added together will give me the present value of my payments. And look at the present value of my payments. It just happens to be the same as the fair value. So what does this mean? As the lessee, Morgan Bakeries is essentially paying for this whole truck. So because of that, this is a finance lease. All right, try the Apple Land computer lease. Try that one on your own, and then you can put your answers in the chat as to whether or not you think it is a finance lease or an operating lease. And if it is a finance lease, tell me which test was met. It is a finance lease, and it is because of the bargain purchase option.